call of the day is Disney, and it got upgraded today to buy from hold. The target 144 from 100 at Jefferies, obviously blew by the 100. Four primary reasons, Jimmy, okay? Yep. Limited risk of a parks shutdown, more positive on cruise upside, continued direct-to-consumer margin expansion, and we view the next 6 months of content and sports slate favorably.
That's a pretty good lineup, and I agree with it all. Let's start with, I'm going to lump the parks and the cruises together. That's the entertainment segment. For the last couple of years, as we've worried off and on about the economy slowing. Go ahead.
I think I said parks shutdown. I meant parks slowdown. If I said shutdown, I meant slowdown. I read it wrong. I was thinking about it. Shutdown? Like, why would the parks shut down?
You know what? There's been times in the last 2 years where it's felt like the stock price was indicating the parks were going to shut down. That wasn't the case. There's been concerns about pricing on the tickets, on food, and everything. But at the end of the day, consumers keep coming back to Disney. Now, the cruise lines are really the strength in the experiences segment, but they're still building out the parks. They're going to build a new one in Dubai. They're expanding Florida. So it looks very good in terms of the juggernaut that is the entertainment sector. I think where we're underestimating things is direct-to-consumer, Disney Plus. That has been outperforming. I think it will continue to outperform. Now, this is important, not just because it's replacing linear, which is in secular decline, but because with Disney at the share price that it's at right now, you actually have to be looking for earnings outperformance versus earnings estimates. And if you're going to get that, I really think the direct-to-consumer segment is where it's going to come from. They just closed Hulu, or rather they got the final negotiation on that. So that's one, other piece of the haircut. It seems like it's all together.
How about this? No competition first half of the year. Netflix versus Disney in stock performance. Similarly, how we looked at Tesla and Uber last week, right? It's been no contest. No contest for the first 6 months doesn't necessarily mean anything for the next 6 months. So Disney's got 79% of analysts with buys. Netflix has 69% of analysts with buys. Next 6 months, Weiss, for the next 6 months, you have Netflix, Jim's got Disney. Which is primed to outperform given the run that Netflix has had and the one that Disney thinks it can still make?
It could be Disney because they have really beefed up their offering with Hulu, the acquisition of it. But, it'll just be a moment in time. I still think that if you're playing streaming, that Netflix, being the pure play, is going to do quite well. So I say with very, very little conviction that it could be Disney. I see no reason to replace Netflix with Disney.
Just one small thing here. If you look at the chart, there's a 3-year channel that it's right at the top of. Yep. It looks like it's going to break out. When it does, Katie, bar the door.
When did you start talking technicals?
I'm just listening. It's so obvious. It's right there.
The momentum is really strong in this name. Just took out the March of 24 high at 123.72. Next one you're talking about August of 22, 126.48. Gets above there, it could go 145.
The other thing is that even though it shouldn't, because it's the same dollar amount, that having a stock selling at $1,300 plus versus Disney at 123 again makes no sense. But that's where retail investors will likely go first.
All right, Santoli's next with his midday word. We're back right after this.